I'm here again with Christian Konchnik of Makimo Konchnik, and if you haven't listened to the first part of this discussion, I'd encourage you to go back and do so you don't get any spoilers. Christian, thank you so much for joining me again. I mentioned last time we want to look a bit more now at charity taxation, but in the meantime, how have you been over these last couple of weeks?
Good. Enjoying the mostly English summer.
You've been here for long enough now. I think you should know that you don't get much of a summer in London.
No, not much.
No, one word answer. I like it. Let's think about charity taxation in a bit more detail. We spent the first half talking about sort of the infrastructural nature of charities in the US and how they sit within a regulatory or a non-regulatory framework. Now thinking more about taxation generally, when you talk about someone getting tax deductions as part of, let's say, a program of philanthropy, what are we actually talking about? I presume we're talking about a sort of a lowering of the amount of tax they'll pay on their income tax return.
That's right. So the US has this concept of adjusted gross income. It's a particular line on the IRS form that we all use to file our tax returns as individuals. And effectively, the charitable deduction is a percentage of your adjusted gross income. And that percentage differs depending on the type of asset that you're giving and the type of organization that you're giving it to. So, for example, we talked in the last episode about the difference between public charities and private foundations. Donations, cash donations to a public charity, the deductibility limit is 60% of an individual's adjusted gross income. So that's quite a powerful thing. It's effectively 60 cents on the dollar for of your adjusted gross income. When you're talking about donations of property, it gets much more complicated. There are a number of differences, depends on kind of what type of property, but let's talk about what I'll call capital gain property. So property that if you sold it, it would generate long-term capital gains to the seller. Donations of capital gain property to a public charity, generally the amount of the donation is the fair market value of the asset that's donated. There are some exceptions to that. It is one of the most complicated sets of rules in the entire US Internal Revenue Code, but generally speaking, it would be the fair market value of the asset that you're donating to the charity, and that would be the amount of the deduction. But in that case, the amount of the overall deduction limitation is 50%, not 60%, and only 30% of that can be with respect to the assets that are donated. So there are a number of sort of differing, and there's a similar regime with respect to private foundations. So private foundations, if all of the contributions are cash, then the deduction limitation is 30% of the individual's AGI. If any portion of it is property, then you're looking at 20%, up to 20% limit, and generally you are only going to get a deduction for the basis of the property that you donate rather than the fair market value. And again, this goes to concepts of potential abuse. So if you have a private foundation, you have it was set up by a family who has significant business holdings. You don't want the family to get a deduction for the fair market value of donating all their business holdings if they had, and then the charity can turn around and sell those business holdings, potentially not pay any tax. Whereas if the family had sold them, they would have a large capital gain. But again, the rules are extremely complicated and do depend quite a bit on the type of property that's donated.
And then I guess from a sort of estate planning perspective, and this is maybe something that your co-partner Chris deals with more frequently than you also get a reduction or a deduction against your gift tax as well if you were making a gift to a charity.
Not your gift tax, because that's during your life, right? But if you make a donation through your will, so it happens at your death, you get an estate tax deduction. You wouldn't get an income tax deduction. And the estate tax deduction works slightly differently in the sense that we mentioned in the last episode that there is a local organization requirement. So if you make a donation to, if you make a donation during your life and you're looking for an income tax deduction, then that donation has to be made to an organization that's organized in the US. That same rule doesn't apply for estate tax purposes. So you could make a donation to a UK charity and get an estate tax deduction, but you couldn't make a donation to a UK charity and get an income tax deduction.
So I come across this more and quite frequently when I'm talking to Americans in the UK thinking about their estate planning and their will planning, because they often will want to put in either a UK charity they want to support. They might also want to put in an alma mater or a US charity that they want to support. And I have to talk to them about what the US and UK tax consequences of donations at death are. And actually, that's one of those cases where the Americans are more generous because you don't mind whether it's a UK charity or not, whether it's a US charity or not, whereas for the last now, increasingly ratcheted up over the last 5 years, the UK has now reached the position where they say we only give charity tax relief of any sort of tax to a UK charity. Not all charities in the UK are registered. There are some exempt charities, etc., but it has to be a UK charity. So we will no longer give charity tax relief on any charity that's outside the UK, which would include the US. So yes, and in the estate planning context, this is where we start to get one of those some of those mismatches. Am I right also in the US that there is no sort of state-supported level of tax relief like how in the UK we have gift aid? There's no sort of claiming back of any kind of additional sums of state support to a charity in the US?
That's right. That's right. So the deduction is sort of the final say in terms of what the amount is. There is no sort of reclamation process like there is with gift aid in the UK.
Yeah, it's gift aid is an incredibly powerful tool and something a lot of very small charities rely heavily on because it effectively allows them to boost their sort of their charitable income by 25%, and it also gives the a higher rate taxpayer the chance to sort of claim relief back in a kind of way more similar to the US. But that 25% available to the charity is a huge kind of giveaway by the Treasury in the UK.
But I think it's. I've always sort of thought about this, and maybe this is wrong. I've always sort of thought about it as a different mechanism of doing something that is not terribly dissimilar, right? In the sense that we're getting a deduction on our tax return, and you don't have to put that on your tax return. You're getting it directly from the government, but the government's giving the money in both cases, unless I'm misunderstanding the way that
the government gives you back some of your money if you're a higher rate taxpayer, so it gives it back to you rather than you deducting it off of your tax return, but it also gives money to the charity for in gift aid. So the classic what's the maths on it? If you give £100 to charity in the UK and you're a higher rate taxpayer, you give the £100, they claim gift aid, they actually then have £125 of tax because they get their 25% extra. You've paid 40% tax and you can claim back the difference between the tax you pay and the basic rate of tax at 20%. And so you would claim back 25%, which is 20% times 125. So the charity walks off with an extra £25 and you can claim back £25. So actually net overall it's £50.
Yeah, right. So then it is a bigger giveaway.
Yeah. So we've kind of touched on these ideas of tax efficient cross-border giving, and more importantly, I guess, tax inefficient cross-border giving. I had the pleasure of talking to Joe Crome, the head of the US-UK or the American Donor Fund at the Charities Aid Foundation and I am sure if he's listening, he would be screaming down his microphone, please talk about donor advised funds. I guess from a structural perspective, if you are a donor, the key thing to start with is to say, make sure that whoever you're giving your money to, you have thought about both the US and the UK tax consequences if you are a UK resident American. Do not assume that just because something is charitable and charity deductible in one country, it is necessarily going to be the case for the other, because therein lies a huge potential pitfall where one tax authority decides it is not charitable and either they don't provide you with relief, or more to the point, if you're, for example, a UK taxpayer and you give money to a corporate charity, that could be treated as a disposal for capital gains tax purposes and generate tax. It could be an immediate inheritance tax charge. for a contribution to a UK company, to a non-UK company. Presumably from the US side, you'd be saying the same thing. You really do have to make sure that what you are looking at is capable of claiming tax relief in the US.
Absolutely. Absolutely. And again, that goes back to that to that local organization requirement that I mentioned before from an income, if we're talking about an income tax deduction. And the American Donors Fund at Charities Aid is a good example of a structure that's been thought about to make sure that it meets both the US and the UK requirements, such that a donation to that fund, and there are several others as well,
Yes.
that a donation to that fund qualifies for both a US and a UK deduction, or UK gift aid and a US tax deduction, so that the deductibility is aligned both in the US and the UK. But that's a good example of a structure that allows that.
So so to sort of talk it through in practice, and for those that don't have the chance to go and listen to the interview with Joe, if let's say you are an American taxpayer living in the UK and you want to give $10,000 a year, or you want to leave $1 million at death to Harvard or to or maybe a charity that doesn't have a UK subsidiary, but just a US charity, rather than making that donation directly and risking that tax inefficiency, you make the gift to the dual qualified charity, the donor advised fund, in this case CAF or whoever else it might be, and they, after taking some commission, can then make the onward donation for you, such that you still got the relief in both countries, and your eventual recipient has got the money from you, and it's all done sort of smoothly and efficiently, rather than thinking you're going to make a sensible donation and then suddenly one country or the other decides that they would like some tax on that. Thank you very much. So, repeating what I said previously, think very carefully about the consequences of any kind of significant charitable thinking, either during lifetime on an income tax perspective or on an estate planning side, will planning perspective. Just make sure to think about the options available.
Yeah, absolutely. And I would just add, there's certainly one additional benefit of a donor advised fund, which is that a donor advised fund, which is what the American Donors Fund for Charities Aid Foundation is. It's what we call a donor advised fund. We're a sponsoring organization for a donor advised fund. Donations to a donor advised fund are treated as donations to public charities. So there is a higher level of tax deductibility available than there would be for a donation to a private foundation. The other thing that can be quite advantageous, and there's no doubt there is a commission that's payable to the donor advised fund, but you could effectively set up your own private foundation within that donor advised fund and call it the Aid and Grant Foundation. It has to be administered separately. It's part of the requirements for a donor advised fund. But it does mean that there is potentially a lot less regulation. Well, there's certainly a lot less regulation that you need to comply with.
Yes.
As compared to setting up your own foundation. You do get a higher deduction. You are paying for that privilege. And of course, the donor advised fund, it's called donor advised for a reason, in the sense that the donor suggests what it would like the donor advised fund to do with the funds, but the donor advised fund has to be very clear that it's not under an obligation to do what you say just because you've said it. They will absolutely take it under advisement. That's the point. But if, for example, they were to determine that it was not an appropriate donation to make because the end recipient wasn't a qualified charity, for example, they wouldn't be required to do it.
So, harking back to something I said in the first part of this discussion, if you are someone who maybe wants to give away $10,000 a year or something, you want to set up your own charity. Like, in theory, there's nothing stopping you in the UK doing that. And if you want to have the prestige and the accolade of having a charity with your name on it registered at the Charity Commission, you are perfectly entitled to do so. If it's a US-UK issue, it's going to get more complicated very quickly. a donor advised fund will charge a commission, but you also aren't having to go through anywhere near the same level of administration for operating your own charity, which in the UK can mean, depending on the form of charity, certain regulatory disclosure requirements to the Charity Commission every year. If it's a corporate charity, then to Companies House potentially as well. And those costs themselves in time as well as actual fiscal sort of financial cost will rack up quite quickly. So, it's not as simple as just thinking, I'd like to give money to charity and I'd like to control it. You are right. It is a bit more grey, and donor advised funds should probably get more of a look in a kind of philanthropy based plan.
I think that's correct. When I have a client who calls me and says, I would like to set up a dual qualified foundation, one of the first things that I do is have a real serious conversation with them about how much they're looking to raise every year. What are they looking to do? What are they looking to do in terms of grants? What do they have in terms of infrastructure that they're able to bring to bear on operating this? Then I talk to them about dual qualified donor advised funds, because I think it's important for the client to know that those options are out there, and maybe they don't want to do that. But I have had several instances where dual qualified organizations in the US, if you don't file your tax returns for a certain number of years, the IRS strikes you off, and then you have to reapply. And I've had several foundations who have been struck off because the founders didn't have the necessary time or infrastructure to be able to devote to taking care of all of the administrative aspects that you've talked about, which are the same in the US. And at the end of the day, what you don't want is for your charity to be struck off. That's not where anybody wants to be. So that is one of the first conversations that I have with clients when they talk to me about wanting to set up a dual qualified foundation, is whether or not that's something that they really want to do and have the ability to sort of commit to running.
What I say to clients sometimes who we get those same inquiries is we say, for the right client, I can conceive of the structure in which that is the right solution. I can imagine why that would be the right solution. Whether you fit inside that example is very slim. And even if you are inside that example, you have to be prepared that it is probably a lot more complicated to set up and to run than you think it's going to be. So you have to be prepared that you are shouldering quite a high upfront and ongoing cost for doing so. But if that's the solution that's going to work for you, maybe you've got lots of UK resident Americans who you are planning to take donations from, and, that is, a threshold that you have passed, and you are accepting that having a dual qualified US UK charity is going to be the best approach, then I'm sure Kristen would be delighted to talk to you. I'd be delighted to talk to you. But for most of those people, there probably are avenues that they'll probably suit them better.
I think that's right. Now, one of the, and I know you mentioned this on the last episode as well, or maybe it was earlier on this one, but the concept of giving to your alma mater, and there are a number of U.S. universities that do have dual qualified branches, effectively.
Yes. What we in the UK refer to like a Friends of charity.
Yeah, it's a little different from a U.S. Friends of structure is different because those are totally separate charities.
Sure.
So a U.S. Friends of organization like the Friends of the National Gallery or the Friends of the Tate in the U.S. is a U.S. 501c3, totally independent of the Tate or the National Gallery or whatever it is. Whereas, Harvard's, for example, dual qualified is kind of part of Harvard,
right? Okay,
rather than a standalone organization, and that's similar with all dual qualifieds. Is that they are, it is sort of a difference in structure, but yes, there are a lot of U.S. universities, like I said, as an example, who do have dual qualified structures because they're particularly looking to focus on the demographic of their alumni who are present in the UK as a donor base. So I think that's the other thing that I always talk to clients about is where do you think your money is going to come from. Where are you going to be looking for donations? Is it going to be primarily in the UK, primarily in the US? If it's in the UK, do you think you're going to have a very significant base of donors who are both US and UK taxpayers? Because that's really what a dual qualified is solving for.
Absolutely. The other thing you made me remember, just as a plug or a warning, if you are a US charity and maybe you are thinking you want to extend into the UK and you want to set up a branch or a friends of, the UK Charity Commission on registering new UK charities gets quite hot on making sure that the UK charity is not merely a fundraising exercise or a funnel. They will expect to see a degree of independent authority separate to the charity. You can have some crossover of trustees, for example, but the Charity Commission will not simply authorize a charity who says every penny that we bring in, we automatically and will forever funnel it up to our US parent. The Commission simply won't allow that. So you need to be wary, and you are exactly right, Kristen, that it is a separate organization with separate independent discretion, who then might decide to give the money onwards, but can equally not pass the money onwards. So, be careful in that construction.
That's absolutely right. And that's very similar to what we would call in the US a sort of classic Friends of organization structure. Like I said, the Friends of the National Gallery or the Friends of the Tate, absolutely the same in the sense that, notwithstanding the fact that the name of the organization is the Friends of the Tate, which might give you a hint as to what it might be intending to do, it needs to be very clear that the US charity is not acting simply as a conduit or a funnel, because then what the IRS says is, actually, you're just giving to the National Gallery or the Tate. Those are not organized in the US and you don't get a tax deduction. So it is similarly important. And there's a couple of revenue rulings that are out that the IRS published. They're from the 60s, but that's what people still look to in terms of the structure and operation of Friends of organizations. But that discretion and control, we call it, that ability for the US Friends of organization to make the ultimate determination with respect to what it does with the funds that it raises, is absolutely critical. And there has to be a communication with the donor that says, this money doesn't just get automatically funneled off to the National Gallery or the Tate or whatever it is.
Last question from me. Do you think we've scared charity trustees or donors enough yet? I'm always conscious when we're talking about like charity and philanthropy, it's a good, positive, wholesome thing, and you want to encourage
it's a wonderful thing
as much as possible. And yet all we've spent the last 2 episodes doing is going, don't do this, be careful of this, it won't do this, that won't work. It's sort of like, we've been real sort of doom casters when it comes to the charity.
It is. I think, and this goes to sort of something you said earlier, but it is an extraordinarily complicated area for something that is supposed to be doing a lot of good.
You want to encourage people to do it.
You want to encourage people to do it, absolutely. But I think, at least in the US, and I don't know as much here in the UK, I feel that the IRS, and this is both in the tax-exempt organization world, but in every other aspect of tax law as well, is that the IRS is constantly being faced with extraordinarily inventive taxpayers who come up with very neat new ways of doing things. And the IRS is constantly running around behind them and saying, no, we don't want that. No, we don't want that either. And that kind of generates, unfortunately, this welter of complicated rules. And of course, you introduce cross-border context and it just becomes, complicated squared.
Yes, of course. Although speaking as one sort of tax advisor to another tax advisor, sometimes when our clients ask us for clever solutions, we want to make sure we find clever solutions for them. They can always change the law. Look, Kristen, thank you for joining me over these episodes today. It's been really fascinating to talk to you about charity taxation. I'm sure we could continue talking for hours if we wanted to. It's clear you have a great passion for charity law. Where can people find you or get in contact with you if they have questions?
I am on LinkedIn. Our website is www.mklawlondon.com, and you can reach me directly at Kristin, Kristin, @ mklawlondon.com.
Wonderful.
And I've been Aidan Grant. Thank you so much for listening, and please come back next time.